Hi everyone, it's Elizabeth Rose. Today I want to talk to you a little more about what influences mortgage rates. We've talked about how the market moves up and down, and it's very dynamic, it's volatile, it's constantly moving. And we've talked about money flowing in and pushing the market higher and improving rates, and money leaving and rates dissipating or pressure being put on rates and them moving higher. But what actually makes it move higher and makes it move lower, aside from the money flowing in and out? And what makes that money flow in and out? Well, it boils down to a couple of things, and one of them that I want to talk about with you today is fundamentals. Fundamentals are the news items. Years ago, before we had the stimulus, before TARP, before the Great Depression and the recession, we had a fairly calm market. And so the fundamentals that were key at that point in time were the big ticket economic data items. Those being inflation. As we talked about, inflation is the arch enemy of bonds. And it is the one thing that we should fear in the mortgage market. Aside from that, jobs. Jobs is a huge influence and a big factor. I mean, let's face it, if you don't have a job, you're not spending money in the economy, you're not buying a home, you're not buying a car. It has a huge dampening effect on our economy. The next thing is the Fed. Remember the days of Greenspan? Boy, he'd speak, everybody listened, it was like E.F. Hutton. And now we have the Bernanke, Big Ben. When he speaks, the markets move. The markets listen. They listen to not only what he says, but wording of what he says can be so influential on the markets. Not only that, we have whispers. You see, when there's whisper numbers or there's whispers about the Fed and what they may do, when the Fed talks about how they may consider something, the markets respond, even if they haven't made a decision. So these things influence the market along with GDP, retail sales, and so forth. So these are the things we're watching. And on top of that, on top of what's happening right here at home, we have what's happening across the pond. Yeah, over in Europe, what they're doing, what's going on over there, their sovereign debt issues, Greece, Italy, Germany, the whole lot of them puts pressure on our market over here. So we have to keep our eye on what's going on in the news and be ready to respond accordingly, or hopefully proactively. You see, the way the markets work, they're quite emotional, kind of like me and you. They have mood swings. And these swings are pretty much dictated by a surprise or no surprise. Think about this. If you know that bad information is on its way, you're sort of braced for it. You're ready. So when it hits, it doesn't hurt so much. It's not like a sucker punch in the gut. And then the flip side of that is, if you're looking for some really juicy, great news, you're already psyched up and prepared for it. So when it comes, you're excited and happy, but it's what you were expecting. Well, take all that away. Let's say you get surprised. You're expecting good news, but it's bad. Whew, that hurts. Or if you're expecting some tough news and you're all braced up for it, and then something really good comes and woohoo, it's a party and you are excited. Even if it's still bad news, if it's not as bad as what you expected, if it's just a little bit better, you're woohoo and all excited. So the markets behave a little irrational sometimes, but actually it's just human behavior. It's me and you, and it's people like us that are out there in the market. They're responding to this information. They're feeling the same feelings that we're feeling, and they're the ones that are out there trading. So if you can try to put a little human emotion behind the market, it sort of makes it all make sense. So those are some key factors that influence mortgage-backed security pricing and the movements in the market each day. Like I've been saying, the market is dynamic, and these days it's volatile. So it's important to keep your eye on what's going on and know what can influence rates so that you can be better prepared. And this is something that your mortgage professional should share with you and be able to help you time the market. And what is the best time for the market? Well, I'll let you in on a little secret. It's darn near impossible to perfectly time the market, no matter what kind of an expert someone may be. It's impossible. We always know the best moments in the market when we're looking in the rearview mirror at what happened behind us. That's when we can best time the market and can't go backwards. So what you want to do is look forward through that front windshield and have all the instruments in front of you and know what to be watching and what to watch out for so that you can make the best decisions and execute on the best rate and the best terms for what's right for you. Hope this information is helpful, and we'll see you next time.